So Cathie Wood was out making appearances on TV again, highlighting her bullishness on Tesla stock. In fact, she gave a price target of $2,000 for Tesla stock. That's incredible upside from where it is trading at today at $164.85. Now, she does not expect Tesla stock to get there overnight. She does expect a few years before Tesla stock reaches that point. Still, the fact that there is over 1000% upside in her target for Tesla stock is pretty remarkable. So, in this video, I'm going to dig into that recommendation by Cathie Wood and look at Tesla's latest earnings results, look at Tesla's late results over the last 5, 6, 7 years, and then look at Tesla's valuation right now and try and understand what has Cathie Wood so excited about Tesla stock. So as you could see here, Tesla stock price at $164.85. This is down considerably off the peak of around $360, and it's down over the last couple of days. Tesla reported earnings this week, and the stock price fell 10% in response to its earnings announcement. The figures in the earnings report were not good, and I'm going to show you that here. Total revenues grew by 24% year over year, which is one of the slowest rates of growth Tesla has experienced in a long time. Total gross profit margin fell by 977 basis points to 19.3%. This was down from 29.1% in the same quarter the year before. I remember one of the bull cases for Tesla stock for a long time has been that Tesla is way out in the lead in terms of gross profit margin for electric vehicles. Well, now that has come down by nearly one third. Its gross profit margin went from 30% to 20%. So it dropped by one third, and it's brought its gross profit margin down closer to some of the legacy automakers. I think Mercedes has a gross profit margin of about 19%. So now it's right around there. Um, Ford, GM, and those, they have a gross profit margin around 10%. So Tesla is still ahead. And then when you're talking about the newer EV companies like Rivian and Lucid, they're still negative gross profits as they're ramping up production. So Tesla's still in the front of the pack in terms of gross profit margin, but the trend does not look good. The trend does not look good. And I've been talking about this for some time. I've been saying that Tesla's gross profit margin is going to come down. And this quarter, lo and behold, Tesla's gross profit margin collapsed. You could have seen this coming. Tesla's cut prices, I think like 7 rounds of price cuts, both in China and in the US, and I believe in Europe as well. So over the last 3 or 4 months, Tesla has been cutting prices on several models in China and the US. And so when you cut prices, it's bound to decrease your gross profit margin. Um, Unless you get a significant boost in sales in response to your cut in prices, which Tesla is not seeing, right? The revenue growth was the slowest in several quarters at 24%, and that's even though the company cut prices. Now, after these quarters results were out, Tesla has cut prices again. So next quarter, the gross profit margin could be even lower because it's already cut prices, I think, twice, and there's still a long way to go for this current quarter. So there could be more price cuts on the way, which could bring Tesla's gross profit margin down even further. Okay, so that's not good news. Next, when we look at Tesla's operating profit margin, that also fell from 19.2% down to 11.4%. So also not good, a 779 basis point collapse. And then finally, free cash flow fell by 80% to 441 million. This was down from 2.2 billion. So negative, negative, negative in terms of the financial metrics. And then here's an explainer of what their strategy is. Tesla says our near-term pricing strategy considers a long-term view on per vehicle profitability given the potential lifetime value of a Tesla vehicle through autonomy, supercharging, connectivity, and service. No, Tesla, please. Please don't be one of those companies that starts talking about potential lifetime value of a customer. I've seen this before with other companies and it only leads to trouble. It only leads to trouble. Potential lifetime value of a customer looks at how much money Tesla can generate from each customer throughout the life of that customer. It assumes that this customer will remain a Tesla customer for a very long time. And it also assumes that this customer will buy more products from Tesla over the years. And this calculation is already full of um, risk because of the mistakes you can make on those estimates and assumptions. Like, how do you know how much money a customer is going to buy over the next 20 years, right? So you have to make estimates and assumptions. That's already a risky endeavor. But it's even more risky when a company that's less than 2 decades old is making these estimations and assumptions, right? If you're a company like Coca-Cola and you're calculating lifetime value of a customer, your estimates and assumptions will be a lot more accurate because you've known your customers for nearly a century. You've seen how your customers react to wars, to inflation, to recession, to depression, to price increases, to supply shortages. You've seen your customers react to a myriad of circumstances over a century. So you've got a better estimate of how they'll respond over time and what their lifetime value is. But when you're a company like Tesla and you're really, really new, how do you know the lifetime value of your customer? I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And so, given that, I suspect they are going to overestimate their lifetime value of their customers, right? And that's going to, in order to give them leeway to lower prices on their cars and tell their investors, look, don't worry about these low profit margins right now. Don't worry about what you're seeing in my financial statement. Think about the lifetime value of a customer. Think about how much money we're going to make off of this customer when we sell them software down the road, when we sell them full self-driving, when we sell them all of these other tech upgrades. Think of those things that are going to happen in the future. Don't look at our numbers right now. Don't look at them because they don't look so good. I don't want you to look at those numbers. And so I've seen this with other companies. I have experience in looking at other companies when they start talking about lifetime value. So I'm hoping that Tesla retreats from this strategy and does not look at lifetime value of a customer and is willing to accept lower or even negative gross profit margins because it thinks down the line it's going to make a lot more money off those customers. So I would caution investors about that, but it looks like Cathie Wood is not cautious about that. It looks like she is optimistic about Tesla's future, especially with regards to Tesla's innovative product and service offerings down the line. Because with Tesla's current business and its current products, I don't think a $2,000 price target is realistic. But if you think about, 5 years later, Tesla could have autonomous driving. It could have a fleet of robo taxis. Now, if you think about that, including that into the business valuation, now you can get in there into that price target close to at $2,000 per share. Now, I will, highlight, focus on the numbers. Please focus on the numbers, right? Companies, investors, people who own Tesla, people who want you to be bullish on Tesla will point you away from the numbers, right? They'll point you to something in the future, something intangible. So, because when the numbers don't look good, that's what they want you to pay attention to, something else. Numbers are falling, right? Margins are falling, free cash flow is falling. And then something I didn't show you, which I do want to show you here. If you also consider inventory increasing to 14.375 billion, up from 6.7 billion in the same time the year before. So Tesla's making all of these cars, they're not finding buyers for them, they're having to lower prices, and still inventory is piling up even after all of those price cuts. So it looks like more price cuts are going to be necessary to meet their production targets, to get rid of this inventory, and that's only going to bring profit margins down further from here. So if you look at Tesla over the last decade, they have done an excellent job increasing their operating profit margin, 16.98%. That's not including this most recent quarter's results. That's not updated here in the Y charts just yet. But that looks like it's turning around now. For the most part, Tesla did this with limited competition. And over the last 2 to 3 years, competition has absolutely soared. Soared. I mean, the amount of production capacity that has come online in the last 2 to 3 years for electric vehicles far outpaces consumer demand for electric vehicles. Even though consumer demand is increasing, but the amount of production capacity that has come online is way more than consumer demand. That's why you're seeing so many governments around the world, that's partly why, offering so many incentives to get people to buy electric vehicles, because on their own the demand for electric vehicles is not as strong as might as these electric vehicle companies will hoped. So finally, I'm going to look at Tesla's valuation, trading at a forward price to earnings ratio of 32.14. That's not especially expensive. In fact, if you look at Tesla's history over the last 15 months, that's the lowest you've been able to buy Tesla stock for in a long time. So relatively speaking, according to Tesla's past, it's not very expensive. But if you compare Tesla to, legacy automakers, then it does look expensive. If I add Ford here, if I add GM, if I add Honda, well, let's just do Ford and GM. You'll notice that Tesla is trading at more than 5 times the valuation of Ford and General Motors, 6.7 and 5.3 forward PE ratios. Now, okay, Tesla deserves a premium valuation because it's better profit margins, because of the technology, but does it deserve a 5 to 6 times premium valuation? Um, you can make arguments for and arguments against that premium valuation. Um, Certainly, Cathie Wood is making an argument that it deserves an even more premium valuation because the stock is going to $2,000 in in the long term in several years from now. So you could see, you can understand why Cathie Wood is bullish on Tesla stock, but you can also see why Cathie Wood needs to focus investor attention on the very long run and away from the right now, because the right now does not look very good for Tesla. The right now, the near term, does not look good for Tesla. All right, so that's all I've got for this video. Thank you so much for watching. I appreciate your viewership, and I hope you'll tune in again next time.